If your goal for 2026 is to learn how to get good at day trading, then this video is for you. I'm going to tell you what platforms to use, what to trade, how much money you need to get started, and set you off with a solid strategy so that you don't waste your time trying to figure this all out on your own. But before we get into that, if you guys could leave a like on the video and subscribe, that would be greatly appreciated. Along with that, I also have the link to the brand new Discord posted down in the description, so if you're interested in that, definitely go check that out. So the first thing I want to go over is the expectations and what you can actually get out of day trading. Some people see day trading as a hobby, others see it as a side hustle or a part-time job, and some people see it as a full-time job. And in reality, day trading is all of these things. It is whatever you make it. It all depends how much time, effort, and consistency you're willing to put in. And this is because day trading, much like anything else in life, if you want to be the best of the best, or if you want to be a professional in a sense, you have to dedicate every day of your life to this one specific thing. Now, this doesn't mean you can't ease into trading, especially in the beginning, but the sooner you're ready to fully commit yourself to it, the better. And with this comes not only a personal commitment, but there's also a varying degree of financial commitment involved as well. And that brings me to my next point, which is how much money do you actually need to get started in day trading? And the short answer is bare minimum around $100 to $200. You can legitimately start day trading in multiple different ways that I will get into here shortly. And that's the nice thing about day trading. Whether you have hundreds of dollars, thousands of dollars, or even millions of dollars, there's a market for every single individual who's trying to get into the space. Now, when I say that there's multiple different ways to get started for around $100 to $200, I mean that you can either start an account through a brokerage like NinjaTrader. And the way that a brokerage works is they charge you a monthly fee, usually around $10 for a data subscription to the markets. And then whatever money you put into your account, you're able to trade with immediately. However, there are limitations to this. If you have less money in your account, they don't allow you to trade as big of sizes compared to if you had more money in your account. And the other way to get started with very little money is what's called a prop firm. And to summarize how a prop firm works, they have you pay a fee to take a trading test. And if you hit the profit goal during the testing period, they then give you a new account that you're able to pull profits from after you meet certain requirements. In most cases, there is an activation fee from when you go from the testing phase to the new account phase. For a majority of prop firms out there, the cost for the test plus the activation fee is usually between $100 to $200. So the next thing I want to get into is the software and platforms involved in day trading. And the first thing I recommend you getting is the app TradingView. And they have an app both for desktop and for mobile devices. TradingView is a free way to see the markets and also gives you access to a ton of really helpful trading tools. And the reason why TradingView is so good, not only is it free, but it's also extremely user-friendly, so it's really good for beginners. And once you have TradingView downloaded and you've created your account and logged in, it's going to look something like this. And the main reason why TradingView is so good is because over on the left here, all of these different trading tools that we have access to, all completely for free, is something that you don't get from your average brokerage or prop firm platform. And I'll dive deeper into TradingView later on, but for right now, it's just good to have it set up and to know what we're going to be using it for. So now that we have our charting platform set up, the next thing I want to talk about is what exactly we are going to be trading. And sticking to the theme of simplicity and ease of use, the absolute best thing that a new trader can begin trading with is NASDAQ futures. And what the NASDAQ actually is an index that includes 100 of the most actively traded stocks on the US stock market. And the reason why NASDAQ futures are so good is that every single day, the exact same thing happens. At 9:30 a.m., the market opens and a huge rush of trades and orders come in. And from that 9:30 open all the way until the 5 p.m. close, there's consistent movement and good price action that allows you to take good trades day in and day out, trading the exact same thing every single day. This means that you don't have to worry about a lack of order volume. You don't have to worry about finding the exact right stock for that day. Every single day you can show up to the NASDAQ right around 9:30 a.m. and have consistent movement that day in and day out allows you to make significant gains. Some other important things to know about NASDAQ futures is that they close every day from 5 p.m. Eastern time to 6 p.m. for scheduled maintenance. And then trading closes 5 p.m. on Friday and reopens Sunday at 6 p.m. every week. So what this means is even if your schedule doesn't fit perfectly for the 9:30 open to the 5 p.m. close, there are still other times of day that you can get your trading in that might line up with your schedule better. It is important to note that volatility significantly slows down after hours, which means that the market is basically just going to move much slower after 6 p.m. and prior to 9:30 a.m. So now I'm going to move on to how to actually find NASDAQ futures in the TradingView platform and in other similar platforms as well. Each one is going to be a little bit different, but generally speaking, it's going to be about the same thing no matter which platform you're using. But for this instance, in TradingView, this is how you do it. So here in the TradingView app, I'm going to open up a brand new tab and I'm going to scroll down to the markets section. And then from the market section, we're going to scroll down until we find futures indexes. So here we have index futures, and you can see right here, E-mini NASDAQ 100 futures. This is the one we're going to click on. And then if you click on full chart, it sends you into the screen here where you can do all of your charting from TradingView. And if you look in the top left-hand corner here, you can see NQ1. That is the ticker symbol that NASDAQ futures uses. And if you want to find it in the search bar, all you have to do is click on it up here, type in NQ, and then all the different NQ futures pop up. These are all going to be about the same thing, but click on any of them and it'll send you to the same graph that you have here. So now that we have our graph pulled up, I'm going to show you some of the essential tools you need, along with some other tools that are very helpful to have when charting. And when charting, using the strategy that I use, there's really only two things you need. Number one being lines, and number two being the long position and short position tool. The line tools are exactly what they sound like, and they're very easy to use. It's going to be this first tab right here. You can click on this. You can set a trend line, which you can mark out different highs and different lows from previous price action, just like that. There is a horizontal line tool here where you can make a horizontal line that extends forever in both directions. There is one of my favorites right here is a horizontal ray tool, which lets you mark the levels of previous lows and highs, and it shows you actually where they start from. So unlike the horizontal line that goes on forever, this one here goes from one single point and then continues on in the future direction. So the horizontal ray is one of my favorite tools to use, and I use that genuinely every single day when I'm trading. And then finally, the vertical line tool. This one is basically, I only use it as a place marker, so I can put it right here, and then when you change time frames from 45 minutes to the 4-hour chart, it lets you figure out where you were when you had first marked out the vertical line initially. And that is basically the main use for this, is like a placeholder, so you can find out where you are on the graph and not get lost when you're switching between time frames. Moving on now to the single most important tool that you can use when charting, and that is going to be the long position and short position tools that are located right over here in the sidebar. You click the drop down. First thing is long position, second thing is short position. A long position is when you expect price to go up, and then a short position is when you expect price to go down. As it goes down, you will make profit, and then long position is the opposite way. As it goes up, you make profit. So let's say from the current market price, you expect the price to go up in the future. What you're going to do here is open the long position tool, click on the current price, and then it's going to set up a green box and a red box. And the red box is going to be how much you're risking if the price goes down, and the green box is going to be how much profit you're going to get if price goes up. So for the sake of this example, we're going to put our profit at this random point and our maximum loss at this random point down here. And what we're going to do now is right click on the long position box and go to settings. And then from here, you're going to ignore everything else except for the risk amount. Right here, it says in US dollars how much you are going to risk. So let's say, again, just for the sake of the example, we're risking $1,000 for this trade, but it doesn't matter if it's $10, $50, $100, $10,000, whatever your risk for the trade is that you want it to be. Enter that number in here, select OK, and then it's going to show you the number of futures contracts you have to buy in order for that number to be a risk. So for me, on this exact trade to be risking $1,000, I would have to buy 1.3 NQ contracts. However, the way that NQ contracts work, you can't buy fractional contracts. You can only buy 1 or 2. You can't buy 1.5, 1.3, or anything like that, like how you can with a normal stock. In contracts, you have to buy whole numbers, 1, 2, 3, 4. There are no fractions. So if I wanted to risk $1,000, I would have to change the actual position at where I wanted my stop loss to be. And I don't actually want to do that But there is a solution to this. And the solution to this is going to be switching from mini contracts to what is known as micro contracts, switching from NQ to MNQ. And the difference between micro and mini contracts is very simple. For every 1 point that a mini contract moves, that is equal to $20. And for every 1 point that a micro contract moves, that is equal to $2. So micro contracts are worth a tenth the price of mini contracts. And what this allows us to do is, if we're in that weird position where a mini contract is at 1.3, 1.5, anything that's not close to a whole number, if we want to get a more accurate setup to where we're risking the exact amount of money we want to risk, you can swap over to micro contracts. You're going to have to buy a whole lot more of them, but it's going to make your setup much more accurate and closer to what you actually want. And the way we do this is very simple. Just like we did last time, we're going to go up in the search bar here and we're going to delete NQ, and now we're going to type MNQ to get the micro contracts. And as you can see right here, micro E-mini NASDAQ 100 index futures. This is exactly what we want. Everything is going to be scaled down 10 times now, but the graph is going to be exactly the same. Literally nothing changes except the contract sizes are smaller, and it gives you a more accurate stop loss to the number that you actually are willing to risk. So last time where it said 1.3 mini contracts, if you look here now, it should say 13 micro contracts. And that's exactly what it says here, 13 instead of 1.3. And 13 is a number that we can actually buy. The 0.3 makes significantly less difference now because, again, everything is scaled down 10 times. So the decimal points on micro contracts basically don't mean anything. Micros are going to be better in general for the new trader because in this instance, we were risking $1,000 for this hypothetical trade. But in reality, new traders aren't going to be willing to risk $1,000 per trade. So if you're willing to risk 50, 100, or less or more than those numbers, micro contracts are going to be way better because mini contracts are simply oftentimes too big for smaller setups. So my recommendation for all new traders is to just stick to micro contracts exclusively, but it is still good to know the difference between micros and minis. Now that we've learned what to trade, how to find it, and the most essential charting tools that we're going to use in order to chart our trades, I want to get into a very simple, basic, beginner-friendly strategy that everyone can use right away. It's very easy to learn and pick up on. And this is also the exact same strategy that I implement in my trading every single day. So now what I have opened up here is a trade replayer, and I selected a random date from this trading year, an actual trading day that happened. This is August 19th of 2025. The time is at 8:25 a.m. So this is before market opens. What I'm going to show you here is what I actually look for prior to entering a trade, along with my actual reason for entering in a trade. So every single trading day, before I even think about making a trade, there's two main concepts that I think about that are going to lead me to the best setup for future success. And these two concepts are going to be trend and liquidity. So now what do I mean by trend and what do I mean by liquidity? So trend is very simple. It just means that when we're in a downtrend, we're setting new lower highs and new lower lows. So just like what we see right here, every new high that is created is below the previous high, and every new low that's created is also below the previous low. So this right here would be a perfect example of a downtrend on the high time frame, which is the 1 hour time frame. So now getting into liquidity, and liquidity is also a very simple concept. All liquidity is unfilled orders above highs and unfilled orders below lows. And what I mean by this is every time you see a high, people are going to have stop losses and take profits above these peaks that are unfilled orders that work like magnets in order to drive price to this area. So there's unfilled orders here, there's unfilled orders here, 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 and so on and so forth. And all this means is that as price starts to go up, it's eventually going to hit these levels again and fill these orders that were never able to be filled in the past. So now what we have to do is figure out which levels of liquidity are going to be hit next. So what we're going to do here is mark out all of the prior highs and lows on the hourly time frame right here. So I'm going to mark out all of these highs above our current price using this horizontal ray tool. And then I'm also going to mark out the lows right here and then right here. So as you can see, we have liquidity in both directions, above and below us. So now what we have to figure out is which ones are going to be taken out first. This is called the draw on liquidity. It means which direction is the market going to move in order to take out the liquidity first before it hits the other ones. And what we can use as our biggest indication on where the draw of liquidity is going to be the current trend of the market. So now that we have the high time frame trend and liquidity zones mapped out, what we're going to do now is zoom into the 1 minute chart so that we can figure out where the best possible entry is for us in order to set ourselves up for success. So now I'm going to change our time frame from 1 hour down to 1 minute, and the 1 minute time frame is where we're actually going to be placing our orders. This is where we go to really hone in on our perfect entry point. So think about when you're looking at the 1 hour or any other high time frame as a big picture of the market, and then once you zoom into low time frame, such as the 1 minute chart, this is where you're looking for that perfect entry that hopefully gives you the least risk with the biggest possible reward. Okay, so now that we zoomed into the 1 minute chart, you can see our landscape has changed a lot. What was a clear downtrend is starting to look like a little bit of an uptrend into a little downtrend with a little bit of horizontal movement, which is also known as consolidation. So in the low time frame, the 1 minute chart, we don't really have an obvious direction at which the market is moving. So in order for everything to line up perfectly and for us to get into a point where we want to actually execute a trade, we want our high time frame trend and our low time frame trend to match up so that we have the best possible chances to catch the movement of liquidity down into this area that we have marked off here as our first level of sell side liquidity. So all I'm going to do at this point is let the graph on the 1 minute chart continue to play out until I see a confirmed downtrend start to form, and then at that point I will look to make my entry. So the only thing we need to have a confirmed downtrend start to form is the formation of lower lows and lower highs. So as we can see right here, we made a new higher high right here, followed by a new lower low. And now depending on if we peak above this prior high or not, that is what's going to determine if this is the start of a downtrend or not. So I'm going to let this play out a little bit, and you see we actually do form a new higher high. So that's not good in terms of finding the actual downtrend. So we're going to have to let this play out even more. And as time goes on, we're going to see if we can notice new highs and new lows being formed. And as you can see right here, we have this high formed, we have a low, we have a new lower high formed here, and now we're in the middle of forming a new lower low. So this to me indicates that we are set up for a low time frame downtrend. That also goes along with our high time frame downtrend. So when high time frame and low time frame are matched up, this is where I'm going to look to make my entry towards the sell side liquidity that we have mapped out as our next potential area that is going to be hit. So what I'm going to do now is zoom in closer on the 1 minute time frame to get a better picture of what we're actually dealing with here. And I'm going to pull out my short position tool that we had talked about earlier. And what I'm going to do is set it up for the current market price. I'm going to move my stop loss to this upper liquidity right here. And that's because if price action were to go above this point, the downtrend would be over, meaning there's no logical reason for the market to continue moving downwards once it has knocked out this low time frame liquidity that we have right here. So I'm going to use this, our previous high, as our stop loss, and then I'm going to move our take profit down to this high time frame liquidity that we have mapped out here in order to set up our trade. Now, just like we had talked about before, I'm going to right click and go to settings, and I'm going to figure out what I want to risk on this trade in dollars. So right here, the way I have it set up is for $250 to be my maximum loss. So I'm going to click OK, and it's going to tell me the quantity or the amount of micro contracts that I have to buy in order for that to be my risk if this is my stop loss. So it's telling me the number is 6. So I'm going to go to my order, change my number of contracts bought to 6 MNQ contracts. I'm going to be selling, which is the equivalent of shorting. Shorting and selling when you're making an order is the same thing. And then from there, you're going to market sell for 6 units. And then as you can see, my stop loss that I've set up here is at negative 240. It's not going to be exactly 250, but it's close enough. And then my take profit is set up at $528. And right here, you can see our risk to reward ratio is also mapped out in our short position tool. And that's just giving you an idea that for risking $250, you're going to win approximately 500. It's going to be a little bit more, but it's going to be 2.2 times what you're risking. So That's if everything goes perfect. We're risking $250 to win approximately $530. So now all we have left to do in this trade is press play on the market and see how this ends up playing out. And as you can see, we're off to a good start. We've continued making a new low, which means our theory that we had a downtrend starting in the short term was accurate. You can see we're getting closer and closer to our profit goal. We're continuing our downtrend. We are getting closer to market open, however, so that's going to throw a little bit of volatility into the mix here. And then once market opens, you can see orders start coming in huge bunches, and we get our full profit on this play here. So in summary, every day before you think about making a trade, first map out high time frame liquidity zones and figure out the high time frame trend. Then from that point, zoom into the low time frame, figure out the trend, figure out the liquidity zones there. And then once high time frame and low time frame trend line up, figure out your approximate risk and your approximate reward with the short or long tool. Figure out how much money you're risking, enter into your trade, and let it play out. And that's really all there is to it. Now, of course, when you're doing this live, there's going to be a huge time pressure put on you, and everything is going to be moving much faster, and everything's going to be a lot harder. But that's where consistency and practice every single day really comes into play. The more familiar you get with these tools and with reading the markets live, the better off you're going to be. And all you can do to practice this is really just get on every single day. You can paper trade, you can just watch and play along, you can take trades in your head, whatever you want to do prior to you actually being ready to go live. Once you are ready and willing to go live, risking small amounts of money in the beginning is a much better idea than going for much bigger sizings that might put you at more of a financial risk. So now that we have a solid strategy set up, the last thing we need to figure out is what platform we want to execute our trades on. The two options being a personal account or through a prop firm. And again, a personal account is where you load your own money into it and you instantly start trading, and every dollar that you make, you keep. Every dollar that you lose, you lose. And a prop firm is where you have to pass a trading test, and then they send you on to a different account if you hit your profit goal. And then from there, you have to follow a set of rules, and once you hit a certain amount of money through that second account, you are then eligible to pull money out of that prop firm. And I know what you're thinking, why would anyone ever choose a prop firm? And that's because the risk to reward on a prop firm is significantly better than a personal account. So on a personal account, if you have $100 in it, it would be pretty difficult to double or triple that into a $300, $400, $500 account in a short period of time. However, with a prop firm, they have maximum payouts that are in the thousands of dollars on accounts that only cost $100 to $200. So you're risking $100 to $200 per attempt on a prop firm with a potential payout of $1,000, $2,000, or even $3,000, or sometimes more in different cases for different prop firms. Whereas with a personal account, you're risking smaller amounts to also win much smaller amounts, at least when you have a smaller account. So let's say you want to get started with a personal account. Now, the platform that I recommend using is called NinjaTrader. NinjaTrader has a very high quality product. It runs very fast. It's very smooth. It's very easy to use, easy to set up, easy to deposit money, easy to take money out. Everything about NinjaTrader flows really well. NinjaTrader can run in browser. They also have a desktop app, and then they also have a mobile app as well. So whatever you want to do in terms of that, you have every single option available to you through NinjaTrader. And the way that NinjaTrader works in terms of account size, for every $50 you have in your account, that unlocks one micro contract. So if you want to trade 2, 3, or 4 micro contracts, you're going to have to add $50 per contract in order to be able to have access to that number of contracts. And then an important thing to note is once you go below those $50 increments, you lose access to those contracts that you are using, and your positions will be liquidated, meaning that they'll be sold immediately once your account goes below a certain threshold. So it's important to always have more money in your account than what you're actually trying to trade with in terms of contracts. So just as an example, let's say you were to put $50 onto an account, you enter in a position with 1 micro, and then your position goes down $5. At that point, your account is worth $45, and you no longer have access to 1 micro contract. So they will liquidate your position, and if you want to trade again, you'll have to put more money on. So it's always good to keep more money in your account than the actual contracts that you're trying to trade with. Hopefully that example made it easier to understand. Now, moving on to the prop firm route, and this is the route that I got started off in, and it's the route that a lot of people get started off in just because the barrier to entry is so low and the potential payouts are so high that it's very enticing to do. And even to this point, point in my trading career, over a year later, I'm still heavily involved in trading with prop firms. And when you want to talk about ease of use and beginner friendliness, there is no prop firm better than Top Step. So the problem you run into with most other prop firms is that they have an extremely long and complicated set of rules that you have to follow that make getting a payout extremely hard. However, Top Step is completely different when it comes to rules. They market themselves as only having one single rule that you have to follow, and that is to get 5 days of $150 of profit in order to pull money from your account. Now, of course, prior to this, you do have to pass a combine, and that combine takes 2 trading days to pass. Each day you have to hit a certain profit goal, and then from there you unlock your Express funded account. And once you activate that account, that is when those 5 days of $150 profit come into play. And then once you reach that goal, that's when you're able to pull out half of the profits that you've made from that point. And similar to NinjaTrader, Top Step has both a desktop and a mobile friendly version that are both very easy to use. And all you have to do to get access to Top Step's trading platform, obviously you have to make an account, and then from there you choose your combine. These are all their different combines that they have. A $50, $100, and $150 option. These are the differences in each one. It shows you your profit goal that you need to hit in order to unlock a funded account through each one. So obviously the more money you pay, it's going to allow you to unlock a bigger account. The position size here is the maximum number of contracts you're able to take. Right here, your maximum loss limit. This is the amount of money you're allowed to lose across every single day that you're trading with the account. $2,000 in total, $3,000 in total, $4,500 in total. Obviously, these get bigger the more money you pay for the account. And then the activation fee for all 3 accounts is the exact same at $129. This is for the standard option. However, they do have a no activation fee route, which is just more expensive, but you don't have to pay that $130 activation fee when you do actually pass the combine. So the no activation fee plans are better if you're good at passing the combines. However, if you're a new trader, you're more likely better off just taking the cheaper route because you're more than likely going to fail more combines than a trader that has more time and experience in the market. So until you're able to prove that you can consistently pass combines, it's better to stay away from the no activation fee route and just stick to the standard route. And then once you actually do pass your combines, pay the $130 to unlock access to the Express funded account. So with all that being said, that should be everything you need to start a solid foundation for success in the year of 2026 in day trading. If you have any other questions, I have other videos posted and I will continue to post more in the future as well.